The US dollar may face a huge crisis from BRICS, ASEAN, and other Asian currencies, as Stephen Jen, CEO of Eurizon SLJ Capital, revealed to Bloomberg that an avalanche of selling USD worth $2.5 trillion could come from Asian countries. Asian exporters and investors may have accumulated a substantial amount of dollars over the years, thereby increasing the region's trade surplus with the United States. As the trade conflict led by the US intensifies, certain Asian investors could withdraw significant amounts of capital or enhance their defenses against a declining dollar, which may lead to a departure from the global reserve currency. The Bloomberg Currency Index indicates that the USD has decreased by 8% since February, while local currencies are performing better than the reserve currency. This situation empowers the BRICS coalition to advance the de-dollarization initiative, as $2.5 trillion in US dollars is at risk. Eurizon SLJ Capital's Jen and Freri wrote, "We suspect these dollar hoardings by Asian exporters and institutional investors may be extremely large, possibly on the order of $2.5 trillion or so, and pose sharp downside risks to the dollar vis-a-vis these Asian currencies." The long-term attractiveness of the US dollar is facing challenges as Donald Trump's initiatives to reshape the global trade landscape lead investors to re-evaluate their strategies based on US exceptionalism. A significant rise in the Taiwan dollar on Monday has fueled speculation that Asian policymakers might be willing to allow their currencies to gain value against the dollar in pursuit of a trade agreement with the United States. Bloomberg's dollar index has decreased by approximately 8% since its peak in February, and all Asian currencies have appreciated against the greenback over the past month. BRICS and various developing nations are currently able to reduce their reliance on the US dollar. Jen stated that there exists a significant global imbalance that jeopardizes the dollar's stability. The long-term attractiveness of the USD is diminishing as local currencies appear increasingly advantageous. These currencies do not bear the weight of debt and enhance each other's GDP when two countries engage in trade. As we proceed, I would like to encourage you to like the video and share your perspectives on the topic in the comments section below. Your input is highly valuable to us and a wider audience around the globe. Financial institutions and brokerage firms are experiencing an increasing demand for currency derivatives that circumvent the dollar, driven by trade tensions that intensify a long-standing transition away from the greenback. Companies are receiving a greater number of inquiries for transactions that include hedges avoiding the dollar and utilizing currencies such as the yuan, the Hong Kong dollar, the Emirati dirham, and the euro. Additionally, there is a growing interest in yuan-denominated loans, prompting a bank in Indonesia to establish a dedicated desk for the Chinese currency. Asian economies have recently endorsed a new rapid financing mechanism that facilitates the use of regional currencies in place of the US dollar. This initiative has been swiftly approved as nations throughout East and Southeast Asia seek to protect themselves from the financial instability caused by US President Donald Trump's global tariff policies, along with the declining value of the dollar, which has led to fluctuations in the US Treasuries market and a surge in Asian currencies in recent days. A weaker dollar is expected to increase import costs for Americans, consequently driving inflation higher in the US. This development may also signal a significant, long-term transition towards a regional monetary system that is less dependent on the dollar. But why are these countries willing to offload dollars now? What does it mean for the US economy and the global economy? And what is the new rapid financing mechanism established by the Asian economies? According to Eurizon SLJ Capital's Stephen Jen, Asian exporters and investors have stockpiled a large sum of USD over the years, and now it is $2.5 trillion exceeded that could soon be dumped as the greenback weakens against local currencies in 2025. Some of these countries include China, Taiwan, Malaysia, Vietnam, and other BRICS and ASEAN countries. There is an important imbalance in the world that puts the dollar in a vulnerable position. Jen, known for his work on the dollar smile theory, had previously said about $1 trillion could flow back to the world's number 2 economy, China, as Chinese companies sell their dollar-denominated assets when the Federal Reserve cuts interest rates. Accelerating the multi-trillion-dollar flows may be naked long dollar positions prevalent among Asian countries that run large external surpluses, referring to positions that are not hedged against fluctuations in the dollar. What does it mean for the US economy and the global economy? Despite the backlash against it, the dollar remains the world's most widely held reserve currency. Thus, it is difficult to speculate about the potential consequences of selling off the dollars by the Asian economies. One thing is clear: the US is losing the advantages that have come with having the dollar as the world's reserve currency. The dollar sell-off will not affect the global economy as other currencies will replace the dollar in trade. What is the new rapid financing mechanism established by the Asian economies? The newly established rapid financing mechanism is an integral component of the broader Chiang Mai Initiative Multilateralization, CMIM, which is a currency swap arrangement involving the 10 member states of the Association of Southeast Asian Nations, ASEAN, along with China, Japan, and South Korea. The 13 countries collectively referred to as ASEAN Plus 3 initiated the creation of a network of bilateral currency swap agreements in 2000, which subsequently developed into the CMIM a decade later. As reported by the ASEAN Plus 3 Macroeconomic Research Office, the lending capacity of the CMIM has increased to $240 billion, with contributions of $76.8 billion each from Japan and China, $38.4 billion from South Korea, and a total of $48 billion from the 10 ASEAN nations. In contrast to earlier mechanisms that depended on the US dollar, this new facility will utilize the Chinese yuan and other regional currencies. This initiative aligns with Beijing's intensified efforts to enhance the global prominence of the yuan by promoting its use in trade settlements, commodity pricing, and foreign exchange reserves. Additionally, Chinese authorities are working to increase the cross-border adoption of the digital yuan through Project M-Bridge, a collaborative effort with the central banks of Hong Kong, Thailand, Saudi Arabia, and the United Arab Emirates. Thank you for watching, and don't forget to subscribe to our channel for new videos on important international topics.